In April of 1933, the United States government did something that most Americans today would consider completely unthinkable. They made it illegal to own gold, not just to trade it, not just to hoard it in large quantities, to own it at all. Every single citizen was ordered by federal law to hand over their gold coins, their gold bars, and their gold certificates directly to the Federal Reserve Bank. The penalty for refusing was up to 10 years in federal prison, and a fine equivalent to nearly $250,000 in today's money. This was not a rumor circulating in the corners of the internet. It was not a conspiracy theory passed around financial forums. It was Executive Order 6102, signed by President Franklin D. Roosevelt on April 5, 1933. And it remains one of the most dramatic examples of a government rewriting the rules of money in real time. Now close your eyes for a moment and imagine you are a factory worker in 1933 Detroit or Pittsburgh. The Great Depression has already claimed your neighbor's savings, your cousin's business, and your own faith in the banking system. Your local bank failed 2 years ago, and you watched men in suits carry ledger books out the front doors while a crowd stood in the cold outside. You spent years slowly, carefully saving, converting a small portion of every paycheck into gold coins because you did not trust paper anymore. You hid them in a tin box under the floorboards because the floor had never failed you the way the bank had. Then one morning, you wake up, turn on the radio, and hear the president's voice telling you that your gold now belongs to the government. You have less than 26 days to comply. The government will pay you $20.67 per ounce. You have no legal alternative. You hand over the coins. You accept the paper certificates. And then, just months later, you listen to that same radio and learn that the government has quietly raised the official price of gold to $35 per ounce. Your savings have been repriced overnight. An instant 39% effective haircut on the real value of what you surrendered. The government pocketed the difference. Historians estimate the profit to the United States Treasury was roughly $2.8 billion in 1933 money, roughly $50 billion by today's standards. You were not robbed at gunpoint. You were not put in prison. The law simply changed around you while you were sleeping and trusting the system. Here's the thing that almost everyone misses when they first hear this story. They think it was a one-time emergency, a desperate reaction to an unprecedented crisis, a dark chapter that could not possibly be repeated in the modern era of transparent democratic institutions and global financial markets. But the story of 1933 is not a story about one frightened president making one extreme decision. It is the opening chapter of a repeating pattern, a hidden mechanism built into the structure of modern monetary systems that has been quietly activated again and again throughout the 20th century and into the 21st. And the mechanics of that pattern are still fully operational today. In this video, we are going to walk through 5 specific categories of assets that history tells us become acutely dangerous to hold when a major monetary system undergoes a fundamental reset. This is not a prediction of imminent collapse. This is not financial advice, and you should always consult a qualified financial professional before making any investment decisions. What this is a careful and documented reading of financial history. Because the people who understood this history protected their wealth across every major monetary transition of the past century, and the people who did not learned the lesson too late. Let us begin with the most important concept of this entire video, what we actually mean by a dollar reset, because that phrase tends to generate either panic or dismissal, and neither of those reactions serves you. A dollar reset does not mean the dollar disappears from the earth. It does not mean civilization collapses or that your bank account evaporates overnight. What it means, in the precise language of monetary history, is that the fundamental rules governing the dollar's value are significantly and often permanently rewritten. It has happened at least twice in living memory. And both times, the architects of the change described it publicly as temporary. The first reset was 1933. Roosevelt severed the domestic link between the dollar and gold. American citizens could no longer walk into a bank and exchange paper money for physical gold at a fixed rate. The dollar's connection to a hard store of value was broken for ordinary people, though foreign governments could still redeem dollars for gold at the official price. The second reset came 38 years later on a Sunday evening in August of 1971. President Richard Nixon told the world that the United States would immediately suspend the convertibility of dollars to gold for foreign governments and central banks. The Bretton Woods Agreement, the carefully negotiated international monetary framework signed by representatives of 44 nations in 1944 to stabilize the post-war global economy and anchor the world's financial system to a gold-backed dollar, was effectively dead before the broadcast ended. When currency markets opened Monday morning, the world operated under a completely different monetary system than it had on Friday afternoon. No vote had been taken, no referendum was held, no international consultation occurred. The United States Secretary of the Treasury acknowledged that Allied governments were not even informed in advance. The Bretton Woods system simply ceased to exist. And the word Nixon used to describe the closure of the gold window was temporary. It was never reopened. The floating fiat currency system that Nixon introduced was never meant to be permanent. By 1976, the International Monetary Fund formally blessed floating exchange rates as the new global standard. The temporary emergency measure had quietly become the architecture of the entire world economy. Now consider what this means for purchasing power. Between 1971 and today, the United States dollar has lost approximately 85% of its purchasing power, measured against the Consumer Price Index published by the Bureau of Labor Statistics. Put differently, $1 in 1971 had the same buying power that it takes roughly $7 to match today. The numerical value of wages and savings rose. The actual value, what those numbers could buy, collapsed. From a fixed gold price of $35 per ounce in 1971, gold climbed to over $3,000 per ounce by 2025. That is not gold getting more valuable in some mystical sense. That is the measuring stick itself getting smaller. The question that this history forces us to confront is this. If the rules were rewritten in 1933 and then rewritten again in 1971, what logical reason do we have to believe the rules are permanent today? That is not a paranoid question. That is the most rational question a financially literate person can ask. Here are the 5 assets that become most dangerous when the answer is none. Asset number 1, long-term government bonds. On the surface, government bonds appear to be the most conservative, trustworthy investment an ordinary person can make. You are lending money to the most powerful and creditworthy government in the history of the world. They hand you a legally binding promise to repay you with interest at a fixed rate for a fixed period of time. It sounds like safety itself. And in certain environments, it genuinely is. But there is a fatal vulnerability baked into fixed-rate bonds that becomes catastrophic in inflationary environments. And that vulnerability is this. The payment is fixed. The world is not. Here is the precise mechanism. You purchase a 30-year Treasury bond paying 3% per year. Inflation then rises and holds at 7% for a sustained period. Every single year, the real value of your coupon payment declines by roughly 4%. The number in your account inches upward. What that number can actually buy shrinks steadily year after year, like sand running out of an hourglass. This is not hypothetical. This is exactly what happened to bond investors across the decade that followed the Nixon shock. After the United States abandoned the Bretton Woods system in 1971, inflation did not stay politely low and manageable. It escalated, fed by the oil embargo of 1973 and by years of money creation to fund the Vietnam War and Great Society programs. By 1979, inflation in the United States peaked above 13%, devastating the purchasing power of ordinary savers across the country. Bond investors holding long-term government paper at lower fixed rates experienced real losses of 8, 9, even 10% per year. Their nominal balance grew, their wealth eroded. There's also a second, equally powerful mechanism. When inflation rises, interest rates rise. And when interest rates rise, the market value of existing bonds falls in direct proportion. The math is straightforward. If you hold a bond paying 3%, and the market is now issuing new bonds at 6%, your bond is worth less to anyone who might consider buying it. They could get double the income elsewhere. The price of your bond must fall until its effective yield becomes competitive with the alternatives available in the market. The longer the bond's duration, the deeper the price decline. Economists call this duration risk. In plain language, it means the further away your bond's maturity date, the more violently its market value swings in response to interest rate movements. A 30-year bond is dramatically more sensitive to rate changes than a 2-year note. This is not a quirk. It is a mathematical certainty. In an environment where inflation expectations are rising and monetary policy is shifting, holding large concentrations in long-duration fixed-rate instruments is one of the quietest risks in the entire investment landscape. The danger is invisible during normal times. It arrives suddenly when conditions change, but something even more counterintuitive had not yet been addressed. Asset number 2, cash savings accumulating in low-yield accounts. Before you dismiss this point as too obvious, consider what it actually means at the level of mechanism. People instinctively think of cash as the absence of risk. The number is perfectly stable. It does not fluctuate with the stock market. It sits quietly in the account, unchanging, and waits. The stability feels like safety. But the number being stable is precisely the problem. Because everything the number is measured against is not stable. Since 1971, the dollar has lost purchasing power in essentially every single year without exception. This is not a prediction. This is a continuous historical record of measurement by the United States Bureau of Labor Statistics. The Consumer Price Index has risen in essentially every year since the gold standard was abandoned. The purchasing power of the paper dollar has declined in essentially every year since then, without exception. And that decline has been continuous and documented. Let us make this concrete. If you had $100,000 in a savings account earning 0.5%, and inflation averaged 5% that year, you did not protect your wealth. You did not break even. In real terms, you lost approximately $4,500 of purchasing power without spending a single cent, making a single error, or taking any obvious risk. The money did not move, the world around it repriced. Now multiply this across a decade. Multiply it across 30 years of careful saving. This is what economists call the inflation tax. It is not levied by the Internal Revenue Service. It is levied by the monetary system itself. It does not require legislation or a vote. It operates automatically, invisibly, and continuously, as long as the currency being held is expanding in supply faster than the economy, producing real goods and services is growing. After the Nixon shock, the United States money supply began expanding at historically unprecedented rates. The constraint of the gold standard had imposed a practical limit on how many dollars could be printed. Once that constraint was removed, the expansion accelerated through every subsequent decade. Large accumulations of uninvested cash held in accounts yielding less than the prevailing rate of inflation are not wealth preservation vehicles. They are slow-motion wealth erosion vehicles that feel stable because the numerical display does not change. The people who watched their modest savings become genuinely modest savings across the 1970s did not make investment errors in the conventional sense. They simply trusted the stability of the paper number and failed to account for the hidden mechanism that was quietly repricing everything around it. Asset number 3, overvalued growth stocks with no current earnings. This connection to monetary policy is the least intuitive on this list, but the mechanism is real, documented, and was confirmed by one of the most dramatic market episodes of the past decade. Here is the chain of causation. When a central bank holds interest rates near zero, as the Federal Reserve did for extended periods following the 2008 financial crisis, and again following the pandemic, money becomes extraordinarily cheap to borrow. Cheap money flows toward the future. Investors become willing to pay enormous prices today for businesses that might generate substantial profits 10 or 20 years from now. The technical term is a low discount rate. When the rate at which you discount future cash flows approaches zero, a dollar of earnings. Projected 20 years from now is almost as valuable in today's calculation as a dollar earned tomorrow. The math justifies enormous valuations for businesses whose earnings are almost entirely speculative and future-facing. This creates a very specific and very dangerous vulnerability. When inflation rises and central banks raise interest rates in response, the discount rate rises. All those projected future earnings suddenly get discounted more aggressively. That dollar of earnings 20 years from now becomes worth meaningfully less in today's calculation. The mathematical foundation that justified the astronomical valuation quietly dissolves, and then the stock price follows. This is not theoretical. We watched it play out in precise detail in 2022. When the Federal Reserve began raising interest rates in response to the highest inflation environment in 4 decades, many of the most celebrated growth companies in the world lost between 50 and 80% of their market value within roughly 12 months. Not because their products stopped working, not because their management teams made catastrophic errors, because the monetary environment that had inflated their valuations reversed direction. Companies trading at 100 or 200 times their annual revenue, companies generating no current profits at all, companies whose entire investment thesis rested on a low interest rate future that was suddenly not guaranteed, saw their share prices collapse with a speed that shocked even sophisticated institutional investors who had studied bond mathematics their entire careers. The stocks that held their value, and in some cases grew during that same period, shared a very different profile. Pricing power, essential goods and services, real, current earnings, businesses that could pass rising costs onto customers without losing them. In a persistent inflationary environment, which is the typical consequence of a major monetary reset, this pressure on long-duration speculative growth stocks does not reverse quickly. Every quarter that rates stay elevated is another quarter that the valuation math is being reassessed by the market. The longer it lasts, the deeper the repricing tends to go. The most dangerous place to be positioned when the monetary environment shifts is in assets whose current price is built entirely on assumptions about a future that just changed. Asset number 4, highly leveraged real estate and interest rate sensitive markets. Real estate is traditionally described as one of the most reliable hedges against monetary debasement. Over genuinely long time horizons, in markets where supply is constrained, real estate's reputation as an inflation hedge is broadly supported by history. Land is finite. Physical property has inherent utility. Rents tend to rise alongside general prices. Tangible assets generally hold their value better than paper promises. But there's a crucial distinction that most real estate discussions conveniently avoid. Modern real estate valuations are not primarily determined by the physical value of buildings and land. They are primarily determined by the cost and availability of mortgage debt. The mechanism is straightforward. When interest rates are low, monthly mortgage payments are small relative to the price of the property being purchased. This allows buyers to justify higher purchase prices because the monthly carrying cost remains affordable. Competition among buyers then pushes prices higher. Valuations rise in close proportion to the affordability created by cheap financing. When rates rise sharply, the entire dynamic inverts. A family that could comfortably carry a $700,000 mortgage at 3% interest cannot carry the same mortgage at 7%. Their monthly payment has roughly doubled. They are no longer buyers at the old price. Demand contracts, prices follow. And the people who bought at peak prices using adjustable rate mortgages or maximum leverage find themselves trapped between a high debt balance and a declining asset value. This exact mechanism devastated significant portions of the housing market when Federal Reserve Chairman Paul Volcker launched his historic campaign to crush the inflation that had been unleashed by the Nixon shock and the oil crises of the 1970s. By 1980, the average rate on a 30-year fixed mortgage had climbed above 18%. The housing market in many regions effectively froze. Buyers disappeared, values fell. People who had leveraged themselves to the maximum to participate in what had seemed like an endlessly rising market were the first casualties. This is not an argument that physical real estate is universally dangerous. The investor who owns an income-producing property with a fixed-rate mortgage in a city where housing supply is structurally limited holds a genuinely strong position during inflationary periods. Their rental income rises with the price level while their debt payment stays fixed. Inflation actually works in their favor. The investor who bought at peak prices in 2021 using an adjustable rate loan with minimal equity, in a market where valuations were driven almost entirely by the availability of cheap pandemic-era debt, occupies a categorically different position. Monetary resets do not destroy all real estate. They destroy the real estate most dependent on cheap financing to justify its price, and they tend to destroy it precisely when the people holding it are least able to absorb the loss, which is almost always at the peak of a rate cycle. Asset number 5, total concentration of wealth inside a single currency's ecosystem. This is the largest and most overlooked risk on this entire list, because it is not a specific asset class. It is a structural vulnerability in the way most ordinary people organize their financial lives without ever realizing they are making a concentrated bet. The vast majority of working people in the United States hold essentially all of their financial assets in dollar-denominated instruments. Their savings account holds dollars. Their bond funds hold dollar-denominated bonds. Their retirement account is invested in companies that report earnings in dollars and hold most of their assets in the United States. Their home is valued in dollars. Their pension is calculated in dollars. Their Social Security benefit, when it eventually arrives, will arrive in dollars. Their life insurance payout is denominated in dollars. Every single layer of their financial safety net is expressed in the same unit, and that unit is the one that has already been fundamentally redefined twice in the past century. This feels completely normal from inside the system. The dollar is the only financial reality most people have ever inhabited. Of course, your wealth is measured in dollars. What else would you measure it in? But monetary history does not operate according to the logic of permanence. No currency in the documented record has maintained its position as the world's dominant reserve currency indefinitely. The British pound anchored the global economy through the height of the British Empire, arguably the most powerful economic force the world had ever seen. Then, across the first half of the 20th century, through 2 world wars, through the exhaustion of imperial capital, through the systematic rise of American industrial and financial dominance, the pound ceded its role to the dollar, not in a single catastrophic moment, gradually, decade by decade, until one day the world had simply reorganized itself around a different center of gravity. The transition took roughly 30 years to complete. During those 3 decades, British citizens whose wealth was concentrated in sterling-denominated assets watched the purchasing power of everything they owned slowly erode, as the world reorganized itself around a different monetary anchor. Today, the dollar's share of global foreign exchange reserves has been declining measurably for 2 decades. Central banks in the world's largest emerging economies have been actively and publicly diversifying their holdings. International trade settlement in non-dollar currencies has been growing. The structural arguments for dollar dominance, while still powerful, are not as unchallenged as they were in 1972 when the United States was the world's undisputed economic hegemon. None of this is a prediction. None of this is a statement that the dollar is about to collapse. The dollar remains the world's most important reserve currency by a substantial margin, and will likely continue in that role for a significant period. But the person whose entire wealth is denominated in a single currency, navigating structural headwinds, carries a concentration risk that most financial conversations never acknowledge. The risk is so embedded in ordinary daily assumptions that it becomes effectively invisible to nearly everyone living inside the system. The people who protected their purchasing power across the great monetary transitions of the 20th century shared one characteristic. They held assets whose value existed independently of any government's monetary decisions. hard assets, productive land, commodities with real industrial demand, businesses generating revenue across multiple currency zones, stores of value whose worth did not depend on any institution maintaining a particular promise about what a piece of paper could be exchanged for. They understood something that is genuinely difficult to internalize from inside a stable, functioning monetary system. Currency is a technology. It was invented by human beings for the purpose of facilitating exchange and storing value efficiently. Like all technologies, it can be modified, it can be upgraded, it can be replaced, and the rules governing its value can be rewritten by a government with sufficient emergency authority and sufficient political incentive to do so. When you hold wealth entirely in instruments whose value is defined by one government's commitment to a particular set of monetary rules, you are making an implicit bet on their permanence. And monetary history provides exactly 0 examples of monetary rules remaining permanent across the full span of generations. Now, let us return to that factory worker in 1933 and sit with his story for just a moment longer. He was not financially naive. He had already watched one bank failure destroy his neighbors. He had already lost faith in paper promises once. He had done exactly what every piece of folk wisdom told him to do. He converted paper money into something real, something that governments could not print, something that had served as a store of value for thousands of years across every civilization that had ever existed. He did everything right, by every rule he had ever been taught. And then one morning the rule changed. He stood in line at the Federal Reserve. He handed over his gold coins. He accepted the paper certificates in exchange. He was told the measure was temporary. He was told it was necessary. He was told it was for his own good and for the stability of the nation. 6 months later, the gold he had surrendered was worth 39% more than what he had been paid for it. And the temporary rule he had accepted, it did not reverse for 41 years. This is the deepest insight that monetary history offers to anyone who is paying careful attention. Every major repricing of the dollar, every significant rewriting of the rules governing what money is and what it can be exchanged for, has been framed at the moment of its implementation as temporary, necessary, and exceptional in character. Roosevelt said the gold confiscation was a temporary emergency measure required by extraordinary crisis. It lasted until 1974 when President Gerald Ford finally repealed it. Nixon said closing the gold window was a temporary suspension to defend the dollar against speculation. The window was never reopened. Not even once. Every extraordinary monetary intervention in modern history has followed this pattern. Emergency language at the announcement, temporary framing in the public statement, permanent outcome in practice. The temporary becomes structural. The exceptional becomes normal. The emergency never quite ends. The monetary system is not a fixed object embedded in the laws of physics. It is a set of human agreements enforced by law and custom and collective confidence that can be and have been fundamentally altered by the stroke of a pen on a Sunday night in August when everyone is watching television and not particularly thinking about the nature of money. Here is the final thought this video wants to leave with you. Most people believe the number displayed in their bank account represents money they own, a solid, reliable, permanent claim on goods and services that will be honored indefinitely at a predictable and stable value. What that number actually represents in the legal architecture of the modern monetary system is an unsecured liability of a commercial bank. It is denominated in a fiat currency, whose value is sustained by a combination of government policy, institutional credibility, and the collective willingness of billions of people to continue treating it as valuable. That is not nothing. That collective confidence is an extraordinarily powerful force, and it has sustained the dollar as the world's reserve currency for decades, and will likely continue to do so. But it is not the same as a fixed, immutable, permanent reality written into the fabric of the universe. It is a social technology. And social technologies get revised. The people who recognized this truth in 1932 positioned themselves before 1933. The people who recognized it in 1968 and 1969 positioned themselves before the Nixon shock of 1971. They did not need to know the exact mechanism. They did not need to predict the precise date. They simply needed to understand the pattern, to ask the one question that most people never think to ask while standing inside a functioning monetary system. What would happen to everything I own if the rules changed? That question has already been answered, twice in 1 century, in 1 country, by 2 presidents. The number in your account is real. The question is only how long the rules governing what that number means will remain exactly as they are today. History already answered that question too.